Good morning, good afternoon, and good evening, everybody. Thank you so much for joining us today in the 20th edition of the CVC Insider, brought to you by 500 Startups. Today, we have a thrilling session ahead featuring Lisa Lambert, who's the Chief Technology and Innovation Officer at National Grid. And Lisa comes from the world of software engineer, then turned into a veteran in the industry, having spent over 19 years at Intel Capital. But before I get started, I wanted to quickly set the stage so you all have some context. First of all, my name is Alba. I'm part of the 500 Startups team, and we are one of the world's most active seed stage investors, having invested in over 2,500 companies in 75 countries. Within 500, I lead our global innovation strategy, where I work closely with corporate investors and other organizations to power their own innovation initiatives and better work with startups. And we started this CVC Insider event series as part of our efforts to build a stronger and more supportive ecosystem for startups and investors alike. So if you'd like to connect with a community of over 1,000 investors from around the world, please feel free to shoot me an email that I'm now going to be dropping into the chat. And every 2 weeks, we host this roundtable featuring some of the world's most active and top corporate venturing practitioners and sharing their unique journey into the CVC, some of the challenges they've faced, the best practices that they've gathered along the way. So if you'd like to nominate a speaker, feel free to let us know. And our host, Nicolas Sauvage, will be moderating the discussion, but there's also a Q&A function. So feel free to ask any questions that you may have along the way. Nicolas, feel free to take it away.
Thank you, Alba. And again, thank you, 500 Startups, for having these really good initiatives about learning about corporate venturing from practitioners and people who have taken very different paths into corporate venturing. Today, Lisa has an amazing career in corporate venturing, and I can't wait to hear her journey and then double click on what she tells us. Lisa, all yours.
All right. Well, thank you. Thank you for the invitation. Thank you for the opportunity to talk to your audience. Excited to be here. I've been doing venture capital for more than 2 decades. And so it's something that is near and dear to my heart. I hadn't anticipated that I would go this route, but I am delighted that I did. It's been a great journey. I actually began my career journey as a software developer. And I started off working in an IT department at a global industry company based in my hometown, Toledo, Ohio. And so for several years, I did IT. I did back office, front office, application development, and support. And knew at some point that I'd want to get into a technology field and work at a technology company. And this is in the 80s, so this is well before the dot-com era had emerged. But that was always an ambition. And so after several years doing development work, I did a business rotation, knowing that in order to get on the big stage and really do technology in a big way, I need to have more of a business background. And so I talked my company at the time into letting me do a rotation where I worked in sales and in marketing and product and strategy before going to get my MBA at Harvard Business School and then making my way ultimately out here to Silicon Valley. Where at that time, this is in the late 90s now, the bull market, the tech bull market was raging, and the timing couldn't have been perfect. And so I joined from HBS, I joined Intel, had other options. I thought Intel was a nice complement to my background because I was a software developer, and Intel is very much a silicon and hardware company. So I thought I'd join Intel. And I thought I'd stay for a few years, just kind of get acquainted with silicon and architecture and how the plumbing works when, in the frame of a computer. And, my background being software, the interchange between the software and the hardware was really interesting to me intellectually. So I thought I'd stay for a few years, ended up staying for 19 years. And the primary reason for that is that after about 3 years, I really stumbled upon what was then called corporate business development, and what was later branded Intel Capital. And so Intel Capital at that time was the largest venture capital organization in the world. We did more transactions by far than any other investor. And we were investing on every major geography. So I did, over the course of my 16 and a half years there at Intel Capital, I did investments on every continent, multiple investments on every continent. And I ended my career running the software and services investment practice. And so we had 80 plus companies in our portfolio at the peak. we invested in 12 to 15 deals a year, new deals a year, not including the follow-on investments. It was more like 30 when you include follow-on investments. And we had some amazing investments. VMware was one of my personal investments. We had a number of others that produced a very good cash on cash multiple and a very good internal rate of return for our investments. And it was just a hot space. Software still is the keystone for venture capital. And so it suited my background, suited my interest. The timing of it was great because it really was right at the beginning of the dot-com era. We got to see ups and downs, as the bubble burst on the dot-com era, but it did come back up. And I think one of the things I've learned is how important your experience is. And, investing through downturns and through peaks is probably the best discipline that any investor can have, because you really do learn what makes for good investments, what makes for good companies. And, you learn to manage during good and bad times. So it was a perfect education for me and a great launching of my career, and really excited for that journey. And of course, it's landed me where I am now, which is running National Grid Partners, which is their venture capital and innovation function, but for the energy sector, which is also in kind of a renaissance. The energy sector is definitely peaking as big tech relies on it, and as the world is concerned about climate change and the impact of fossil fuels and energy in general on society and on the world. So it's been an amazing journey, really exciting. Happy to talk to you a little bit more about it as we go through the interview.
Thank you so much, Lisa. I want to start with the very beginning of your introduction, which is software engineer. And clearly, I can see why Intel Capital wanted to have someone with a technical profile. And if I look at Intel Capital's investment, a lot of them are on the application side, so you need to understand hardware and software. But could you tell us about how useful it is today for someone to have a technical background to make good investments, versus maybe the argument that if you don't have a technical background, maybe you're actually less biased by the technology breakthrough and therefore more the business?
Yeah, you probably can make an argument for both. I think technology as a background is important. The thing about venture capital that is not true of other financial sector activities like investment banking, it's not transactional that way. It really is about understanding the product, understanding the market opportunity, being able to identify quality team, and having confidence that there's a window of opportunity for a good team with a good product that solves a real problem to actually have success. So it's far less about financial management and much more about technology, product, and team. And I don't think you really appreciate how difficult it is to start a business, in a new or emerging category and have success scaling that business. And so not understanding the product piece, not understanding the technology, to me seems like a major disadvantage. I think some combination of both is actually most helpful. And so that was the reason I went to Harvard Business School, because they are very much known as being great managers, great in finance. And then the background as a developer gave me the foundation to be able to relate, communicate, be credible with technical founders. And so some combination of those things to me feels like the right balance rather than, focusing one on or the other.
Very nice. And I feel like you've been in one of the best schools in the world. And I don't mean Harvard, I mean Intel Capital for learning corporate venturing. In the last 5 years of you in Intel Capital, and you clearly created different initiatives, including the Diversity Fund, what do you think was the biggest learning of that last 5 years compared to the first 16 years you were in Intel Capital? Clearly, you were at the very beginning of Intel Capital, so there was a lot of maturity phase. But the last 5 years is where you were really credible. You knew what you were doing, 12 to 15 deals per year. That's significant. So what was his big takeaway from the last 5 years?
As compared to the first 5 years, or just in general?
Yeah, so out of 16 years, you had the first 11 years and then the last 5 years. What was a big takeaway from the last 5?
Got it. Well, the concept of pattern recognition or pattern matching is real. That's probably the biggest takeaway. You hear a lot about that in the venture capital world, that there's value in not just having intellect and not just having, technical acumen or financial acumen, but the repetition of looking at lots and lots of companies and seeing different outcomes, seeing different teams, seeing different products and how they get consumed in the marketplace. That is irreplaceable to be an effective deal maker. You have to have that judgment. What was beautiful about Intel Capital, because it was so large and because it was global, we saw more investments than I think any other firm on Sand Hill Road or anywhere in the world. As I say, we were doing more investments in Intel Capital than any other firm. There was one year, I think in 2019, that we did over 350 investments in a year, invested over $1 billion. This is just equity, right? So just imagine how many investments you have to look at to do 350 in a year. It's like a 40-to-1 ratio. So the repetition, the experience of seeing lots of different investment opportunities and seeing winners and losers, and the formula for becoming a winner or a loser is unmatched. And what I had in my last 5 years that I was developing over the first 11 years is that pattern recognition, that judgment on what makes for a good company and what doesn't. What are the yellow flags? What are the red flags? What are the things you need to fill once you've got a team and a product as you scale it? What capabilities do you need? What relationships do you need? How do you execute? What team dynamics you need? All those things you learn through the process of the experience of doing investments. There's no replacement for it. The problem is that, early in your career, you just don't know those things. And so, you rely on intellect, you rely on your educational background, and, you're going to make mistakes. Every investor has had bad investments. The good ones learn from the bad investments. So that's another part of the education. But that definitely is the difference. I was so much more confident in the last 5 years of my career at Intel Capital than I was in the first 5 years of my career. And that made the world of difference.
And I think that's really nice and candid of you, because the mistakes are at the time, they are not obvious they will be mistakes. Otherwise, you would not invest. You're convinced they will be successful. Can you share maybe not the name, but an example of a mistake where this was a huge learning for you, because looking back, there was something you could have guessed, but you saw it, you didn't act on it, and you still invested. If nothing was obvious, of course, this is different. But here, I'm talking about you had an intuition or a sense, but you didn't listen to that one.
Yeah, I'm sure there are many instances of that. I think I'll give you a general statement rather than naming names, but one of the big things is early in your career, you spend so much time on the evaluation, and it's very easy to lose objectivity about a deal. And one of the things I told my team later in my career is you can't become married to a deal or to an idea because you've invested so much time and energy in it and you're convinced that it's a winner. You have to always look at any company in relation to a world of possible investments that you could pursue. Never become too involved, too committed. Maintain your objectivity when you're evaluating a company, because you invest a lot of time in your process for doing due diligence and for evaluating winners versus losers. And it's very easy to not listen to those intuitions, those instincts that you're referring to, those words of caution, once you're committed to it. And at Intel, we made it worse, because at Intel, we kind of had a quota, if you will, of investments that we had to do a year. We were graded on the number of investments that we did, the performance of those investments. And so you became even more married to an idea if you've invested so much time into it. And so it closes the door to hear some of those alarms, some of those cautionary tones that you may have discovered during the course of your due diligence, and put you in a situation where you regret not having listened to that inner voice, not having been more thoughtful about the potential risk. And, it's a part of the process of developing judgment. So it's not something that I look back on and I'm disappointed about, but the incentives do matter. And if you're incented to do more deals, then you're probably going to make some of those mistakes and not pay as much attention, especially when you're brand new to the process. So I think if I had to go back and do it all over again, it would be care less about the KPIs for Untitled Capital and care more about producing quality investments, because in the end, you're going to pay for it if you don't.
I think your point about number of investments as a KPI is a very dangerous KPI. It's beyond vanity KPI in a way. It's driving the wrong behaviors.
Precisely.
Yeah. I remember in our first year, I rewarded my team for the deals they spent more than 200 hours in due diligence and decided not to invest. So in their bonus at the end of the year, I rewarded for actually them deciding by themselves to drop it. So that I think it takes way more courage to drop something you've invested so much time than actually to go because it's still okay to propose.
Yes, way more courage. And early in your career, it's difficult to resist the temptation not to go with the flow. It's difficult to stand up and say, no, I'm going to be courageous and I'm going to acknowledge the reality of this opportunity and not try to sugarcoat it in my own mind. And it's very easy to do very early on. You don't want to look like a fool either, right? You've invested that much time. You really don't look like you made a mistake or that you had bad judgment. So all those things play into it. When you don't have the confidence and the experience and the, giving yourself the patience to really ask yourself the tough questions, then you can make mistakes. Later in your career, you don't do that. You just don't tolerate that kind of behavior because you know what the outcome will be. So maybe in some ways you have to go through it because you have to fail to realize that's not a good approach. But, to the degree that we can help some people today who are early in their career, don't get caught up in that cycle, because in the end, you're going to be the only one that's paying for it, because it's going to be your investment and it's going to forever be on your track record.
It's going to be on your name. Yes. So you talk about lose objectivity, which I think is a golden nugget, and I want to really triple click on that one. It's impossible to, of course, remove any subjectivity. Actually, you meant lose subjectivity. How do you make sure that you're conscious about your subjectivity in an investment and you don't get married to the idea of investing in a company?
Yeah, I think looking at a lot of companies is a big part of it. One of the things that I required of our team was to put together an investment strategy in a particular area. So if you're going to invest in solar technologies, right, you'd have to do a complete landscape market scan of the sector, why we would invest, what the strategic benefits are, what the business models are, who are the players, know the entire landscape, and then meet with them, the landscape. That is, take time to get to know each one of the companies to make sure that the company you're selecting is truly the best breed. And so it took a lot more time, but I found that the decisions were better because now you can be more objective because you've looked at the entire solution stack, the entire landscape, and have been able to make a judgment based upon an equal set of data. Sometimes I see investors fall in love with a company, they lose their objectivity, they believe that's the best in class, but they haven't done their homework. And so putting together an investment strategy and having the discipline to look at all of the competitors in that landscape before you make an investment is one sure way to maintain some objectivity in it, because now you're looking at data. Now you're looking at the opportunity as it's described by each one of the companies. And I think you can be more accurate and have a better outcome if you do that.
I think it's one of the advantages of corporate VC versus an M&A team. An M&A team is proposed a deal and it's a very binary yes or no. But a corporate VC can be much more proactive, looking, okay, we have one startup coming our way, but let's look at the full landscape.
Correct.
I want to, so you mentioned yellow flags and red flags. Can you share with us, and that I think would be very useful for the audience, some red flags that you did not appreciate they were red flags until later on? And that happened to me, so I really want you to share some examples.
Well, probably the biggest red flag is team. We did a study at Intel Capital on our entire historic portfolio and the reasons why companies were successful or unsuccessful. And what came up repeatedly as the primary reason for failure is the lack of execution and team. And so I think people overestimate market size and market opportunity. I think they overestimate product. At the end of the day, you can have the best product in the world, but if you don't have a team that can execute and deliver on the promise of the value, then you have nothing. And honestly, it seems obvious in reflection, but it's not. It's just not. The technology generally is the first thing as a venture capital investor, is the first thing that you look at. Is the technology differentiated? Is that advantage sustainable? And then you look at, is the market big enough to accommodate you growing to a size that's sufficient enough for you to make a good return? Those are typically the first 2 or 3 things that you look at. But in the end, it's all about the dynamics of the team, the capability of the team, gaps in the team, your ability to recruit the team as you scale, right? So it's not just the executive team, but it's the broader team, and the ability to create culture and cohesiveness so that you stay on point, you stay on the vision, you stay on the strategy, you pivot when you need to. So self-aware, right? That you're not married to a strategy or an idea, but you're married to being successful, and that may require you pivoting. In fact, in most cases, it does require you pivoting. And so it all comes back to the people. And I don't think early in my career I would have ever thought that. Early in my career, I thought it was all about the product and the opportunity and how unique it was and differentiated it was and how many people liked it and all of those things. But in fact, it really is all about the execution. You don't have good execution, you don't have a good business, no matter how great the technology is.
So this one is a tough one, and I'm probably guilty of that, and my team as well, is when we put an investment proposal together, the slides on the team is maybe 2 slides out of 30 or 40. We spend so much more time on everything else. You could argue some of the slides is about execution and past execution and the track record somehow, but this is still like a 10% of the investment proposal being made. And yet you're saying it has a disproportionate impact. How do you do it in NGP? How do you make sure that the team is really being due diligence, not just the idea, the product, the technology, the market, but really the team? Any tips?
Yeah, a big part of it is hiring a team that has investment experience, meaningful investment experience, because they know those things, right? They won't fall into those traps. And so when I started National Grid Partners, my criteria for hiring investment professionals was that they'd have a minimum of 10 years as professional investors with a minimum of a 20% IRR, a 3x cash on cash track record. And so when you're dealing with those numbers, then they've learned all the things we've been talking about on the show for the last 30 minutes. They've learned about team, they've learned about product, they've learned about execution, they've learned about evaluating the entire landscape, all of those things. And so that's a big part of it. If you're going to hire, please hire people that are professionals. What I see so often in corporate venture capital is they hire product specialists. Oftentimes they hire people within the company that work in product or operations or business development, and they hire them to be the professional investors. And it's a recipe for disaster. This is a trade, as I mentioned earlier, that requires experience, pattern recognition, which is enabled by experience, and managing lots and lots of opportunities. And to assume that because somebody is an expert in an area that you're specializing in terms of your investment approach, that's going to be successful is just a big fallacy, and it happens all the time in our business. So get the right talent and then have a thorough evaluation. We spend probably a third of our time in our investment theses around the team, and it's the collective team. It's the leadership team. It's the broader team. Where are their gaps? Where do we have strength, and then we want to shore that up? It's the advisory board. We spend a lot of time. In fact, I do diligence every advisory board member. And I do certainly do one-on-ones with a handful of them. We just did a deal on investment in a company called Pathar. They've got about 12 people on their advisory board. I diligenced all of them. I met with 4 or 5 of them just to get a feel for the broader team. This is the team that supports an early stage company like Pathar. So we do that, and we do the same thing with the board. So in terms of time spent in our due diligence, we probably spend a third of our time just on the people element than the rest of it.
So you're
it's
very
important.
consistent on really deep diving, due diligencing the team. Was it a late stage or early stage startup you invested?
Yeah, this is an early stage startup. So this is a seed stage company that we invested in. We just closed their Series A round. So I think even more so when you're dealing with very early stage, because you just don't have enough of other data that you can use to judge, quality, execution, track record, all those things. So I spend more time on those early stage companies, but I think the principle is true across all the stages. At the end of the day, you're gonna win or lose on the backs of the leaders of the team and their network. And if it's not strong, then you can expect you're gonna have more troubles than the typical VC backed company.
And I think the 10 years of experience also connect to what you said earlier about your experience in Intel Capital, where you experience the ups and the downs. And the cycles are normally within a 10-year period.
Yes, that's right. And so all of these people, given the time that I'm hiring them, have gone through a couple of iterations of ups and downs. So they know what good looks like, and they know what bad looks like, and they know how to manage through those peaks and troughs. And that is important. Again, it goes back to judgment. And your judgment is framed by your experience, and your experience you want to be framed by as much diversity as you can have. You don't want it to just be all good days, because as soon as you have a bad day, you're gonna struggle to get through that.
Yep.
And so that's what I was looking for. That's why I said 10 years. It wasn't arbitrary. It was actually important because I think it did cover the peaks and the troughs. And so I know these people know how to deal with challenges, and they've had their bad deals and they've had their great deals, and all that informs their judgment as well.
Very nice. And so maybe one more question about the team due diligence. What about those who are just starting a startup? This is their first experience. They don't have a network or track record into the space. Would you have something, maybe a stronger bias against this kind of first-time founder?
Not so much. I mean, the company that I mentioned, Pathar, you can check it out at pathr.com. First-time founder, not first-time entrepreneur. He worked at other startups, but first time he's founded a company. I don't think that's as big an issue. I think there you need to make sure that the broader support system is there. He had a great advisory board, really great advisory board, both domain knowledge, in the sector, the product area, industry knowledge, because he's targeting multiple vertical markets. And so he had people from retail and from commercial real estate and from manufacturing industry. And just perspective as an entrepreneur. They were almost all entrepreneurs. So they kind of been there, done that, know how to engage a customer, know how to scale a business. And so I think you look at that. When you don't have a big team, it's seed stage, then you look at who does he have around him? Does he understand what his weaknesses are? Does she understand what her strengths are? And are they wise enough to find people around them to help balance their strengths and their weaknesses? That goes to judgment. That goes to leadership ability. And I just think those skills are really helpful, because you're going to have ups and downs. You're going to have challenges along the way. And so knowing that you need help on the journey is a really good sign. And the companies that I would be worried about are the companies where the technical founder is the brain trust, and there are very few people around them that fill the gaps that may be blind spots for him, that would be a concern. I think when you have a situation like what I had with Pathar, you feel very good about it because you know that person's balanced and knows where they need help.
Very, very nice. Talking about recruitment, so you're looking for 10 years plus experience. They've gone through the up and downs, they know, and they've had good financial returns. You talk about very good IRR and multiples. What else are you watching for your recruitment? And I'm talking your new CVC, National Partners. What were you watching for your first few recruits?
Well, I mean, in terms of the investment team, the profile is similar. You want the good performance. In our case, we also wanted people that had experience in the energy sector and in the enterprise IT sector. And so, you need to find a balance there. Our mandate is to invest to support the operating business of National Grid, our sole LP, our parent. And that includes information technology. So how do we engage our customers? How do we manage our assets? The tools that we use for magnifying, amplifying our product benefits and value proposition, employee productivity. So all of those IT-related cybersecurity and such topics. But then the asset side of the business, predictive maintenance, next generation energy technologies, and the like. So those are the things that we're looking for here. Do we have people that balance that skill set and that can actually help on both sides of the equation? And really, that was kind of how we looked at hiring the next level beneath our VPs.
Very nice. And that's for the investing team. How about the rest of the teams that engage much more closely with National Grid?
Yeah, so I mean, just by way of background, I just tell you a little bit about National Grid Partners and what we do. So we're investment and innovation, but we have 5 functions to deliver on that promise. The innovation team is our new business creations team. Think of it as a seed fund, if you will, inside of National Grid, where we're ideating and standing up new MVPs, minimally viable products, scaling those into something that can be consumed and spun into an operating business, or in some cases spun out of the company and funded through our incubation unit or our external seed fund. So that's innovation, really important capability there, very close to the business. We have an incubation function as well, and that function is our literal seed fund, where we're investing in seed and Series A stage companies that are aligned with our operating businesses, either supporting our IT mandate or supporting our OT, operating technology mandate. And we house those investments in our San Francisco office, which is our incubation facility. So there, we want to stage, but we want to stage the strategic because we want to use that as the lens from the business unit into the next generation of technology. So this is the 3 to 5 year window where the industry is going and what are the companies that are leading the way, right? So we want business engagement with those companies, and we want our executives to be able to look at those opportunities to inform their business decisions, right? And we incubate them for that reason. They actually work out of our San Francisco office, so we have more access to them. That's function number 2. Function number 3 is the traditional CVC, corporate venture capital, expansion stage, investing. And those are more mature companies that are oftentimes more strategic, meaning they meet an immediate need in the short-term window, kind of the 1 to 3 year window. And it's important for us because we do need companies that we can actually deploy. So we expect with those companies that we're going to get insights, learning, we're going to get proof of concepts, pilots, and ultimately we're going to get deployments. And they're going to be delivering value practically to the business. So that's the CVC. The last 2 functions are business development, which is our group that's responsible for capturing the value for those first 3 functions for the business. And so whether it's an innovation that we develop internally or a seed investment that we incubate or a CVC company that we're doing a POC or a pilot for, they're responsible for being the interface to those teams, the NGP teams and the business unit to make sure we do end up capturing the value for the business unit. Many CVCs don't have that function. The investment professionals are responsible for making sure strategic value is realized, and is a major distraction and very time consuming. I broke that out completely gave a dedicated team to it. And now investors can be investors, innovators can be innovators, and the business development team is the one that kind of cashes in on all of that effort with the business. And then last but not least is our Venture Accelerations group. The idea here is that how do we bring the entrepreneurial ecosystem and that mindset into National Grid? And we have a number of programs that we use to facilitate bringing that knowledge in, that insight in, helping to change the culture, helping to bring more commercial skills, helping to get a feeling on the sense of urgency and the dynamic that a startup endures. We're a regulated utility. I mean, the risk profile for a regulated utility is very low. The risk profile for startups is very high. How do you bring that mindset in so that you can create more of a sense of urgency around us doing what we do as a regulated utility? And so we've got our Venture Fellows program, which is a 2-year program that we do with National Grid employees. We bring them into National Grid partners to do a rotation with us for 2 years. So they're going to get firsthand experience working across all these different functions and all of the insights that you gather from doing that. We have a sprint program, which is a 3-month version of our Venture Fellows program. Very short, you come in, you do a sprint, work on a project, and then go back to the business with hopefully a lot more insight about the startup world and innovation world. We have secondments where we bring our executives into work in our portfolio for 3 months. So we have a finance person that goes to work in one of our companies in a finance role. They're getting real firsthand knowledge working at a startup, and then they bring that back. So those are some examples of programs that we do. It doesn't move the needle in a very large way, but it does begin to plant the seeds. And changing the mindset is such a big part of changing the culture, and exposing them to the kind of work that we're doing really does get us there. It may take longer to do it that way, but I think it's well worth the effort. And frankly, we're getting their help and support and building rapport with the folks that are in the business, which is good for us as well. So that's National Grid Partners, and that's kind of how we hope and like to add value.
There is so much I want to double click on what you said. I think you said a golden nugget already, which is make sure to separate the business development team from the investing team. So the investing team really focus on investing, and the business development really focus on the bridging or liaising between the startups and the companies. Is that so maybe the question is, how do you transition from the relationship, the goodwill is created between the investor and the startup? At which point do you start to introduce a business development person? Before the investment decision, at the investment decision afterwards?
Yeah, good question. Good question. Yeah, we like to do it sooner rather than later. So we have a 2-step process, approval process at National Grid Partners. We have our first step, which is our deal concept meeting, which is where we bring in the idea of the deal. What is it? Why do we think they're going to be successful? Why is it strategic? Operating success, track record, all those things. Post that meeting, we have our investment process approval meeting, we call it the IPA. And that's the meeting that we've completed due diligence and we're ready to move forward with the investment. We typically bring the business development team into the process right after the deal concept meeting. They, of course, have exposure to the company, but what we don't want to do is have them spending time on companies that we end up discontinuing. Yep. And so when we feel post the deal concept meeting that we're going to go forward, it was approved, then we get them involved. They typically have technical meetings with the strategic sponsors in the business unit and their operating team, because a part of our objective is making sure that we think the company is strategic, we think the company will benefit National Grid, that we make the connection with the people that actually would purchase and deploy the technology. And so part of that is assessing strategic fit, but also giving them an opportunity to assess quality, product quality, and whether it solves the particular use case or business need. And so that's the sweet spot for us. And it's rare once you get to the IPA stage that we would discontinue a deal. So they generally just run with it post that point, and then they own the relationship. They're responsible for making sure that the things that we agreed to in a business collaboration agreement get executed, and that value is captured by the business unit. So that's the answer.
It's really excellent. And what would be the KPIs on this business development? Clearly, they're responsible for making it happen, but some of it is outside their control. They know there is a fit with National Grid, but things can change. So how do you track their performance in making it happen?
Yeah, so we've got an allocation of what we call strategic investments and pathfinding investments. So our expectation is that 60% of our investments will be strategic and 40% will be pathfinding. So we've got a view for future-proofing the business with the pathfinding, but we're getting real value in the meantime with the 60%. They're responsible for delivering on that 60%.
I see.
And so it really is a partnership between the business development person, the business unit, and the investor. What we don't want is for the investors to only bring pathfinding deals. And so the agreement, the unsaid agreement, is that they need to be bringing things that fit use cases. One of the things that our business development team does is they liaison with the business and define the strategic priorities and the specific use cases that are required to deliver on those priorities. And the investment team then goes and identifies companies that fit in those use cases and those strategic priorities. And so between those two groups, they manage the deal flow such that we get enough that's strategic, and we're at 78% strategic right now. So we index on strategic. You never want to be short of that. But that we have enough room that we can go and experiment every now and again. So the primary objective is making sure that we stay within that 60% target. They're responsible for making sure that we do that. But the investors do need to make sure that they're bringing companies that fit the use cases. They don't control whether a business unit consumes it, but if you fit the use case and they've done their homework well enough, then they're going to trust our judgment on this is the best in class for that particular use case. And we generally don't have issues there. On the pathfinding side, we have a lot more room, a lot more latitude, doesn't require business unit sponsorship. But at some point, it does have to become strategic. So we don't do pathfinding in things that aren't relevant. We do pathfinding in things that are 3 to 5 years out, just not 1 to 3 years. And so, it's a bit of a trust relationship, but it's mostly about understanding what the business priorities are and then making sure we match that activity in the investment teams. It actually works. So we don't need a lot of KPIs. And there's a lot of detail there, which I won't go into, but at a high level, that's kind of how it functions.
What I like about your setup, and I think the 40%, 60% is really a communication or setting expectations, but you clearly have two categories, one that can add value quickly to your corporate, and some of it comes from use case that your corporate said they want. And the pathfinding is where you actually look for potential disruptions that are coming, not obvious yet.
Correct.
And you define the KPIs from that.
That's right.
I really like it. So there is a lot I want to ask, but I will want to talk about something I've never heard before. And I think it would be very interesting because this is actually about adding more value to the corporate in terms of changing culture and mindset, this kind of change agent, which if I understand it well, you're doing it it's very subtle, but I think it's what you're doing, which is you have this fellowship rotation of 2 years where you train someone. I mean, clearly they add value to National Grid partners, but for 2 years, they learn so much about innovations and investments and startups and all of that. And then they come back to National Grid with a totally new mindset. And then you talked about the sprint where you actually give this kind of inoculation or something. For 3 months, they learn very, very fast and they get exposed and then they can come back. And then you have this work inside the portfolio company for 3 months, which I've never heard of, which I think is genius. So can you talk about the 3 and how you got to define them and how do you define success for each of them?
Yes, absolutely. Well, I mean, for venture fellows, I won't take credit for that. There is an equivalent Kaufman Fellows program within the venture capital industry, which you probably are familiar with. It's kind of for up and comers, people that have been investing in under 2 years, and it's an immersion in all things venture capital. So I got the idea from that. We don't implement it in the same way, obviously, but I really like the idea of having a fellowship of people that are experts in NGP and the things that we do. So we designed the program to be longer because to really become expert in the work that we do, you really have to spend a meaningful amount of time. Persuading the business to come along on that journey was a bit of a trick, but I think in hindsight, I think they recognize that the only place they're going to get this kind of experience is at National Grid Partners. And if we really do want to future-proof our business, which is why they hired me, what they've asked me to do, then you've got to have your operators skilled in these things, or at least aware, right? And so that was the thesis there. How do we make as many people that are key stakeholders for us smart about what we do, so that when we go back to them, they understand. They've also taken some skills with them that they wouldn't have got otherwise, but they're an ally and a champion for us in the business unit now after spending 2 years with us. That was the thesis around the Venture Fellows program. Around the sprints, we know we're going to get hundreds of people to do these venture fellowships because they're 2 years long, and who can give up an employee for 2 years? And so it's a shorter version with the exact same objectives. How do you create allies? How do you create champions? And how do you create the skill set that is required and that is available in the startup ecosystem and even in the innovation ecosystem? How do you create that skill set within our operating businesses? That serves our interest. I think it helps the company, but it serves our interest to have people that are more commercial, that are more market driven. In a regulated business where you don't have to worry about those things as much because we don't compete in market with other utilities, it's still good to have that skill set. And our market even is evolving and changing. The regulated model and the rate cases that we do are changing. The rate case cycles are shortening. The focus on just top line growth is reducing. More regulators are looking for profits and not just top line growth, asset recovery. And so as the business model changes for the parents, we want to make sure that the people that are running the operations are changing with it. These sprint projects serve that purpose. They also solve very specific needs. The topics that we choose for the people that we bring over are real problems in the business. And so they work on that within National Grid Partners for the 3 months, and then they report that back to us and to the operating business. So it's productive in that you're doing real work, but it's also very insightful in the same way the Venture Fellows program is. Secondments is, to me, the dream state, right? I mean, there's no other way to understand what it's like to be an entrepreneur than to be an entrepreneur.
Yep.
And we can teach you and expose you to as much as we possibly can, but you are never going to know it until you've worked at one. And so I'd love to do those longer than 3 months. That's all I could get them to agree to. But I think that is firsthand experience of the pressures, the complexities, the challenges, the opportunities, that you're never going to get working in an operating business in a regulated utility. And so it's firsthand knowledge. That's always better in my view. Getting more of our executives to participate in that is my goal. We had to put them on pause because of the pandemic. It's not as effective when you're doing it virtually. Being at the facility with the employees really does make a difference. But I think that concept is a really compelling one. And so we hope to pick that back up as we come out of this.
It's so impressive. So let me ask a few questions, because I think there is a lot of mechanics with the secondment. There is IP issues, there is who pays for what, how do you get the organization to agree with it? How do you solve it? Yeah,
so we pay for the headcount. And so they don't come off of our payroll or out of our employee base. We pay for it. They basically are just doing, a remote assignment, if you will, right? That's the way we treat it within National Grid. The way the company treats it is, one, they don't have to pay for another employee, and they get specialized expertise in a particular field from someone that, that understands the business and the market. I mean, most of our companies do sell into utilities. In fact, I think probably all of them sell into utilities. Even some of the pathfinding companies who we're not required to be strategic with do or have targeted to sell into the energy sector. So we already have some customer knowledge that is unique, and having that sitting in the office next to the marketing team or working with the marketing and sales team proves to the portfolio company to be invaluable. It's not just a free resource, but it's a free resource in a market segment that they're pursuing. And so now they get to find out, really, how does it all work? How do we best sell you, right? They get to ask those questions. So, it's a win-win around the board. And yeah, I'm really pleased with that program. I'm hoping we can do a lot more of it.
Very nice. When you say they pay, is it the portfolio companies or the mothership paying? I wasn't sure.
It's the mothership. Yeah, sorry, we pay, meaning National Grid pays. So they stay on our payroll in our employee base. It really is just a remote assignment.
That's a lot of goodness for the portfolio companies.
Yes. No, they love it. They love the insight. They love the free help. They love the kind of the direction that they get, because part of being successful if you're a startup working with corporate venture capital is how do you navigate the corporate? How do you shorten the sales cycles? How do you add value? What are the priorities? Getting that insight from somebody that's an employee of the parents that's sitting right next to you. I mean, that's incredibly valuable to the startups. It's a win-win.
Ask one more question about this, which is a logistic aspect. How do you get to know who in National Grid is willing to do it? And then how you match it to different portfolio companies? It's not like you have 100 resumes and you show all of them to your portfolio company. So logistically, how does it work?
Yeah, so logistically is we identify high potential employees and we match those high potential employees with our portfolio company needs. And so it's a combination of the investment professional and business development working with our HR department to create those matches. And it may sound complicated, but it's really not that complicated. We know who our high potential employees are, we know what their backgrounds are, and we very much know where the needs are in our portfolio companies. And so we create matches. If we have a marketing person that wants to do this, then we look for a company that has a need for marketing support. And you will find that the high potential employees are eager to diversify their experience and to expose themselves to other ways. And so we've had no shortage of people interested in either literally joining National Grid Partners as an employee or participating in any of these programs where they can get exposure to what we do. It's a pretty hot business unit at National Grid.
Very nice. I'm not surprised. And I think one of the golden nugget is it's a partnership with human resources. It's also part of recognizing the high potential upcoming leaders, giving them access to this opportunity.
Exactly.
And so back to my earlier question about these three amazing ideas and you're executing on them. How do you define success for each of them? Because clearly there's a change agent element to it. So how do you define success?
Yeah, well, I think for a Venture Fellows program and sprints, it's, have they produced quality work? So that's an objective measure, maybe a subjective measure as well, and the evaluation of their performance. Did they deliver on what they've set out to deliver? Did it solve the problem that they were trying to solve? I mean, so it's just like it's work, right? It's project work. So did they achieve that? And then we actually have a specific set of KPIs. I don't remember all of them, but we do have a pretty detailed set of KPIs on how we're judging these. I'd say other things are, is there measured improvement in a skill set around a particular area? Commercialization is a big one. National Grid is very much an engineering company. It's a utility. So we're in the business of managing assets. And so a lot of engineers at National Grid. And so to the degree that we can measure by an evaluation, by a survey, by some means that they've acquired commercial skills is another important one. And then feedback from our portfolio companies. We do net promoter scores for our portfolio companies. And did they get value in it? We do them every year for National Grid Partners as a whole. But in these cases, we do them on the spot post a secondment or post an engagement. And we ask them, how did it go? Did you get value out of it? Would you do it again? And so those are some things that we do to measure whether we're adding value or not.
So you touch on something I love, is a Net Promoter Score, the NPS survey. And it's not for the score, it's for everything you learn next to the score.
Yes.
And this is very rare. I haven't heard many corporate VCs, let alone financial VCs, doing it. So can you tell me how you introduced it and what is the biggest value you are getting from these NPS surveys?
Yeah, it's exactly what you said. It's the feedback. I mean, the number is one thing. You do care about the number. We set targets. We actually have performance objectives, and we tie it to our bonus, actually. So that's a big deal, right? I have discretion around that. I have discretion on what my objectives are for the bonus, what my team is going to have to achieve. And so that is an explicit one. How are we performing on Net Promoter Score with our portfolio? And so we get rated on the number as well as the qualitative data that we get in the surveys. But we launched that because we're a brand new venture capital firm. I launched National Grid Partners in November of 2018, and so we came on the scene, at a time where there are lots of venture capital firms, and there are an increasing number of energy-focused venture capital firms. And so how do we differentiate ourselves? How do we stand out? How do we gain momentum with entrepreneurs? How do we build the pipeline up? Those things. And because we are strategic, meaning that we expect to get a financial return and we are measured on financial return, we actually have a shadow carried interest program. But because we're strategic, we need to be delivering value into the business. And so we're making commitments to our portfolio companies that a part of our investing is us introducing you to our business units to be prospective customers, and also introducing to an organization that I launched about a year and a half ago called the Next Grid Alliance, which is an alliance of utilities. I mentioned earlier, the beautiful thing about utilities is that we don't compete in market. And so we can actually come together in an alliance and share best practices and share deal flow and ideate together and partner together. So we have this Next Grid Alliance that is now 65 member companies. There's over 150 utilities worldwide, but we've got almost half of them in our alliance already, just after a year and a half. And so another part of our value proposition is we're going to not only give you visibility and access to National Grid as a customer, but we're going to give you visibility and access to the Next Grid Alliance members as potential customers. They love it because they want to see new and innovative technology to solve their problems. And the portfolio companies love it because they get a prospective customer. And so we want to know how we're doing all those things. How is the engagement with the business unit? Is it slow? Is it fast? Is it effective? Are you getting POCs? What do you think about that? How is the engagement with the Next Grid Alliance? Are you getting value from it? How is our support to you as an organization? Are we doing the things we said we were going to do? We're keeping our promises. Are we adding value as board members, observers, and others? And so we ask them those questions. Every year, we ask them those questions. And the qualitative feedback is so valuable. We've always scored very well, by the way, on those as you can imagine. But the qualitative feedback is really good because they give us information that we can tweak the operating model, how we do what we do. And generally, it is a tweak. It's like this should have happened, or this took too long, or you did outstanding there, and the exposure and visibility that we're getting through your PR mechanism is amazing. You know what I mean? So we just, It teaches us what we do well, and teaches us the things we don't do well, and we shore up the things we don't do well, and we really push hard on the things that we do well. And I don't know how you do our business without having some sort of feedback loop with the investors.
I recognize everything you said. We were planning to do it once a year. A year ago, because of COVID, we thought, well, entrepreneurs have too much to deal with. Let's not have the NPS survey. We just did it last month. It's amazing the qualitative feedback you receive, and things that are obvious and things that are not obvious. And I think that if more corporate ventures were to do it, they would say exactly what you said. How could I have done it before without? You need this feedback loop.
Exactly.
So with that in mind, do you see your portfolio company as your customer?
Oh, we have several customers. I mean, our portfolio companies certainly are our customers. The business unit are our customers. Even, the Next Grid Alliance members are our customers in a certain way. So yeah, they most certainly are. And we do everything that we can to meet their needs, to keep our commitments. And to help them be successful. At the end of the day, they want to have a successful outcome, and so do we. And successful outcomes to us is both quantitative, we're producing a return for the business, and qualitative, we're adding value to the portfolio company in a way that helps them be successful and win. So it's a good marriage, and you just need to be very clear up front what each is bringing, and then you need to follow through and be serious about it. No catchphrases, oh, we're entrepreneur friendly, or whatever, right? Just do it. Do the right thing, and keep your word. That makes all the difference.
About what you said you would do and do it. I think it's the best way to finish the interview. We're at the top of the hour, but it was really inspiring and very concrete. You have really good concrete actions that I think we should look at and consider. So thank you so much, Lisa. This was really nice. Thank you.
My pleasure. My pleasure. Thank you for great questions and being very thoughtful about it.
Thank you. Bye, Lisa.